I don't think people understand how some investors protect themselves from massive losses, even when the markets take a hit. The answer is in how they structure their portfolios. In this video, we'll break down how to create a diversified investment portfolio, a strategy that helps you spread risk while boosting your chances of long-term success. If you're serious about growing your wealth while safeguarding against market volatility, you'll want to stick around until the very end. We'll walk you through step by step, so you won't miss any crucial details that could make all the difference. Let's get started. Let's start with the basics. What does it mean to have a diversified portfolio? A diversified portfolio simply means spreading your investments across different types of assets, stocks, bonds, real estate, and other securities, so that you're not too reliant on the success of any one investment. The goal is to reduce risk. When one part of your portfolio underperforms, another part might perform better, balancing out the impact. The old saying, "Don't put all your eggs in one basket," is exactly what diversification is about. If one basket falls, you don't lose everything. So, why is diversification so important? Here's the thing. No matter how much research you do, it's impossible to predict exactly which investments will thrive and which will struggle at any given time. The market is unpredictable, and there's always the chance that one sector or company could take a hit. Diversifying your investments helps you avoid relying too heavily on any single asset. It spreads out the risk and provides a safety net during market downturns. For example, if your stock investments take a dive during a recession, your bonds or real estate investments might still hold steady. Think of diversification as a form of protection. It doesn't guarantee you won't face losses, but it helps cushion the blow and gives you the chance to recover faster. Over the long term, this balanced approach tends to deliver more stable returns. Now, let's talk about the types of assets you can include in your portfolio to achieve diversification. There are several options, each with its own risk and return potential. Let's break them down. Stocks represent ownership in a company, and they offer higher growth potential, but also come with more risk. When building your portfolio, it's important to diversify even within your stock investments. This can mean investing in different industries, companies of different sizes, or even stocks from various countries. Bonds are essentially loans you make to a company or government in exchange for interest payments. They're generally less risky than stocks, but also offer lower returns. Bonds are great for adding stability to your portfolio. When stocks are down, bonds can provide a consistent income stream. Real estate investments can be physical properties, such as rental units or real estate investment trusts, REITs. Real estate tends to be less volatile than the stock market, making it a good long-term addition to a diversified portfolio. Plus, real estate can provide passive income through rental payments. Commodities include natural resources like gold, oil, and agricultural products. They tend to move independently of stocks and bonds, which makes them a useful diversifier. However, commodities can be quite volatile and are generally better suited for experienced investors. These investment vehicles pool together a variety of assets, such as stocks or bonds, allowing you to own a diversified mix without needing to buy each asset individually. Mutual funds and ETFs are ideal for beginner investors because they offer instant diversification with a single purchase. By including a mix of these asset types, you're well on your way to building a diversified portfolio. Now that we've covered the main asset types, let's talk about diversifying within each of them. For example, when investing in stocks, you don't want to put all your money into just one company or sector. Instead, invest in different industries such as technology, healthcare, or energy, and companies of various sizes, large cap, mid cap, and small cap stocks. This way, if one sector or company struggles, your entire portfolio isn't at risk. The same goes for bonds. You can diversify by investing in both corporate bonds and government bonds, or bonds with different credit ratings and maturities. Each type of bond behaves differently based on economic conditions, so having a mix helps manage risk. Even with real estate, you can diversify by investing in different types of properties or regions, reducing the impact of downturns in any single area. When building your portfolio, it's essential to strike the right balance between risk and return. Your asset mix will depend on factors like your risk tolerance, investment goals, and time horizon. Some investors can handle more risk because they have a long time horizon and can ride out market fluctuations. Others may prefer stability, especially if they're close to retirement. The more risk you're comfortable with, the higher your allocation to stocks might be. If you're more risk-averse, you'll likely lean toward bonds and other stable assets. Are you investing for long-term growth, such as retirement, or are you focused on shorter-term goals like buying a home? For long-term growth, you'll want a higher percentage of stocks in your portfolio. For short-term goals, it's wise to keep a more conservative mix, with a heavier allocation to bonds or cash. The longer your investment timeline, the more risk you can afford to take. Younger investors typically have more time to recover from downturns, so they can allocate more to growth-oriented investments like stocks. If you're closer to your financial goals, such as retirement, you'll want to focus more on preserving your wealth, which means shifting towards safer assets. And that's it for today's episode on how to create a diversified investment portfolio. By spreading your investments across different asset types and diversifying within those categories, you're reducing risk while still positioning yourself for potential growth. Remember, a well-diversified portfolio is key to long-term success in the world of investing. Don't forget to regularly review and adjust your portfolio as your goals or market conditions change. Thanks for tuning in. If you found this episode helpful, be sure to share it with others who might benefit. Until next time, happy investing. And don't forget to subscribe to our channel and like this video for more valuable investment tips and strategies.